Hi there, and welcome to another episode of Simple Money, where we talk about different topics around money from a different generational perspective. And today we're talking about something that is, I know, just going to be so exciting to everybody, but it is near and dear to our heart, and that is mortgage refinancing. Refinancing. So Dave, you don't have a mortgage. What hops into your mind when you hear that refinancing? Does it even have any bearing to you? What's it mean?
Yes. Well, hello everybody. Yes, refinancing. So it does have a bearing for me, I guess, because while I don't have a mortgage, I have been trained by you in the mortgage world, and I do have a car. So I have refinanced my car, which is along the same terms of replacing your current loan that you have on something. In this case, we're talking about mortgages, so replacing the current loan on your house with a new loan for a particular reason. And so that's what refinancing is. I did not know that before coming into the mortgage space, or kind of growing up, I guess. But obviously, I know
Yeah.
now.
So yeah, and you bring up a great point. So refinancing isn't just for mortgages; it's for sort of any type of debt, right? So people think about how do I save money, and so the very simple answer of what refinancing is: okay, so if there's a way to save money by reducing the interest rate or changing the terms of the loan, whether it's a car loan, a student loan, credit cards, people are interested in that, right? How do you save money? And so the objective of a mortgage refinance is typically to try and save money or achieve some other financial objective, and so forth. And so a couple of things I hear, and Dave, you can share things you've heard. What's kind of funny is that we might help someone purchase a home with a purchase mortgage,
Hmm.
and they don't always know that we can do the refinance, right?
That's very true. Yeah, no, a lot of people ask, "Can you help me with a refinance in the future?" And I always, well, of course, the answer is always yes. But I've always thought that's an interesting question.
Yeah,
So,
right. And so, and I bring it up only because I think that if you have a trusted relationship with any financial person in your life, you'd want to go back to that person to sort of start a process or have at least have a conversation about whether or not it's kind of important. So, what are some of the common mistakes that people make when they're refinancing a mortgage? There's the things that you've noticed or popped out in your mind.
yeah, I think one of the big ones is probably not realizing maybe the benefit to the people that are refinancing. So what I mean by that is they don't take into account maybe all the costs or resetting their loan term or something like that. So they don't take in all the factors really in when they're refinancing to accomplish their specific goals. A lot of times, the question or the response by people is, "Hey, I want the lowest interest rate," and they'll skip what does that cost, what does that do for me, how long does it take to break even, all those things, and just go straight to what's the lowest interest rate. And so that's not always the most important thing. And I guess looking at the entire picture, and walking somebody through that is where a lot of people make mistakes. They don't incorporate those things.
Yeah, so you've said a lot there, and we can break down a little further, right? So you mentioned
Mhm.
costs, you mentioned lowest interest rate, you mentioned term. Uh, so uh, what does term mean? I mean, what's even that even mean to someone who's thinking about a mortgage? Whether and again, this could apply to someone buying a home, and if they don't even have a mortgage. But in the context of this, we're talking about refinancing. But what's the term of a mortgage?
Of course, yeah, term. So how long you're going to, have that mortgage, or how long you're obligated to pay that mortgage, I guess, is the loan term. The most common loan term, which we've probably touched on this, is 30 years. Everybody kind of gets a 30-year mortgage. There's other terms. The common ones are 20-year, 15-year, 10 years, things like that. But the reality of it is that you can do any sort of term. You could pick a term of 28 years, 23 years, whatever it might be, and do that. But, in the industry, we tend to think of 30-year and 15-year really. Um, and so when you're paying your mortgage for a couple of years and then you go to refinance, a lot of times you reset that term back to a full 30-year term, which could be good or could not be good. It just depends on the situation. So that's what we mean by term.
And the mistake that people make around that is that, let's say you're 3 years into the mortgage and there's 27 years left on that term, right? So you've agreed to pay 360 payments or 30 years. Um, at least hopefully you remember doing that. But put that aside, there's 27 years left. And then the lender shows you that you're talking to shows you, oh, here's a lower payment, but now we're back to 30 years, right? Which means now you end up paying interest again over another 30-year period where you've already paid interest for 3 years. And it's not always a bad thing, but you need to be
Hmm.
aware of it, right? You need
Hmm.
to be understanding what the total cost of the mortgage is over time, which is the analysis that we really try to help people understand and deeper into. So I think sort of the biggest mistake people is not understanding term and extending the term, and the extending of the term is what reduces the payment, not actual interest savings, right? So that can be tricky for people. You also mentioned something else here, Dave, about uh, different term, 28 years, 26 years, 22 years.
Hmm.
What's that all about? Because when I grew up, you didn't have any of those choices, right? You took what the lender offered, and that was it.
Yeah, yeah, that's I'm sure. Yeah, a lot of things we see, even the common misconception of, hey, I need 20% down to buy a house, right? That's just kind of something that's ingrained in everybody's heads, and I think that was ingrained in many people thinking, hey, I need a 30-year mortgage or a 15-year mortgage. There was no other options. Now it's all very customizable with technology and everything, so you can literally pick how many months you want on your mortgage or how many years you want as a term, and it could be done. Even I mean, we could talk about interest rate real quick, but you've always told me, and you started this, people would do rates on a 1/4% or an eighth of a percent. And now it could be customized, very, very down to, tenth of a
Hundreds,
percent,
right?
whatever it is, hundreds of percent, right?
Yeah.
So, yeah, it's obviously more customizable and, technologies help with that.
But which is
So,
pretty cool. We won't spend a lot of
mhm.
time digging into that, but that is a great point because mortgages traditionally were by eighth increments, and now they are no longer. And so they're and if anything, it just means you need to do better analysis, which is more choices, but how does a consumer analyze the right choice,
Mm,
right? And
yeah.
I think that's where we come in. All right. So another thing that happens, you mentioned, costs. So how does someone think about the costs? And there's we see, and I'm going to give you a twofer here, David. So we see advertising with really low interest rates that don't seem like they're even possible in the current market environment, and which happens all the time, but it happens more so during a refinance environment. So you have the cost of refinance, and then you have these sort of points that go to. So talk about that a little bit from your perspective.
Yeah. Yeah. Of course. I do love when clients or other people share advertisements of, hey, get your whatever percent rate, and it's a lot lower than what the market might be. And then you read the fine print on the bottom. It goes, this comes with X amount of discount points, which and sometimes can be a lot. A recent case was that they were offering like 5.5%, and it came with like two discount points, and what that was in actual dollars was like $25,000 or $30,000. And so the client didn't know that; they just saw the advertisement that a lower rate was being offered. But then once you get into the fine print, it has a lot of costs associated with it. So there's always costs involved in a refinance. The main cost that we can control through rate is a discount point or discount points, and so that's where we want to really look at the benefits of, hey, is that what we want to do, or is that not what we want to do, and do an analysis on your specific mortgage and plan. So that's kind of the discount points portion of it. I think you had a twofer, but I don't remember now.
Well, it was just the costs involved because there are
Mhm.
costs, and then of course,
Yeah.
does it ever make sense to pay significant discount points on a refinance? Uh,
Does it? Well, it could, sure.
it could. It depends on the environment.
Yeah.
So again, it goes back to analysis and your goals. Generally speaking, in a declining interest rate environment, where you think there may be additional opportunities to save on interest down the road, but we don't know. You don't want to minimize your costs in the current transaction in order to leave the door open.
Yeah, exactly.
Whereas by paying $25,000 in your example, David, now you've incurred this huge cost, and if there's another opportunity to refinance, it might take you 4 or 5 years to recover that $25,000. In which case, you might miss out on a much better deal later on. That's the
Yeah,
downside.
absolutely. Yeah, we were actually just talking to through a client plan, and it was to pay a little bit of points to get a lower rate or to not do that. And he was kind of thinking the same thing. Hey, I think rates are going down. I want the he wanted to break even in less than 1 year to leave the door open for a refinance in a year or two. And so the decision was to not pay those discount points because it would have taken longer than a year to break even. And so again, like you said, it depends on their plan. And if we're in a falling rate environment, usually it doesn't make sense to pay a lot of discount points or lower your rate.
What's that mean break even?
Okay. So yeah, like if you're so right now you have your mortgage, right? And you're paying your monthly payment, paying your monthly payment, paying your monthly payment. Then you go to refinance. So we get a new mortgage. There's costs, like we just said, to do that. Um, so all those costs usually get added into your loan amount, and they can be, or you could pay them out of pocket. But so there's costs, right? So if you're saving, $500 a month, and you just spent a couple $1,000s on refinance, there's a period where you're actually behind, right? Because you just spent money out of pocket to get a refinance done. And so, you might have a 3 or 4 month break even before you're now ahead of paying less interest. And, the costs that you just spent are saved through a new refinance. So that's what we mean by break even.
Um, Great, and maybe I'll expand on that a little bit because it's not a linear thing. If people
Mm-hmm.
think, okay, I had $1,000 in costs and I saved $200 a month, it must be a 5 month break even, but that's not true. Um, and the reason that's not true is because of amortization, right?
Yep.
And where the
Mm-hmm.
interest falls and the rest of it. So it's never a linear equation, although I can tell you the majority of lenders sell it that way or explain it
Yeah.
that way, and it's not actually correct. And so the break even actually in that example I just gave you, the 1,200, will actually end up being less because you have a lower interest rate. So maybe it's 3.7 months or somewhere in that range, but it's not 5 months. That's
Exactly. And that's always an interesting concept or conversation to have because it takes a little bit to grasp, right? So, that's a good one.
the other sort of mistake that we see people making, and sometimes it's combined with this cost question. So going back to the $25,000 guy, um, I'm sure he didn't think about how he might pay that $25,000. What would have typically happened if he had just kind of kept going with that process and hadn't sort of realized what was being fed to him by the lender?
Yeah. Typically, the lender he was working with, it was just included in the new loan amount. So his loan amount was higher by, $25,000, $30,000. So he was not coming up with money out of his pocket. So it was just being wrapped into his new loan amount. So now his loan amount's way higher. His interest rate was a little lower, but his loan amount's way higher, and it's going to take him longer to get that loan amount down. So he was actually going backwards, for a while.
And
Um,
probably a pretty long while.
yeah, a pretty long while. And it's interesting when you think about like, oh well, the costs were wrapped up in the equity in my home already. Equity is still, I guess, wealth in a way, and you're not exchanging dollars out of your pocket or out of your bank account, but it's still wealth, and you need to plan for that and realize that it's still, money that you're spending.
Yeah, so increasing the mortgage balance, maybe by 1,000 or a couple $1,000 is probably fine. But when you're financing significant costs, you're actually hurting yourself because you're increasing your loan
Mm-hmm.
amount. So maybe you're doing all these things. You're extending your term, you're increasing your loan amount, and you're paying a
Yeah.
lot of discount points to do it. You got the triple whammy, and the reality is you might be, in a worse situation for maybe 5 years or longer. Who knows, right? It's hard to
Mm-hmm.
kind of know.
Yeah.
So when people also think about refinancing, they do other stuff, right? So sometimes they've taken other debts. Is there something to look at there, David? I mean, should people be considering other debts or lines of credit or those sorts of things?
Yeah, absolutely. When you're looking at your mortgage debt, I think you should also look at any other debt that you have, whether that's credit cards or car loans, student loans, personal loans, whatever loans you have. You should work with your mortgage professional and mortgage advisor, and really take a deep dive into what those loans are, what you're paying on them. Many people don't realize that they're paying 20+% on a credit card, and they're going backwards. By only paying the minimum payment. Some people don't realize that their student loans are doing the same thing, right? When they're on kind of different repayment plans with their student loans, they're not really paying off any principal, just paying interest. So yeah, I think you got to take into the whole picture of what's leaving you, what interest you're paying, what cash flow is being sent out of the house every month, and if you take a big picture idea and knock it down into a mortgage, and maybe you can include it in the mortgage itself to reduce interest savings or reduce interest costs, excuse me, or reduce, your monthly cash flow to save some money and use it elsewhere to invest or something like that. That could be a good thing. What do you think?
Yeah, I mean, oftentimes when people are refinancing, there's been so much growth in equity. There's this temptation to say, "Wow, I could get my hands on some of that money, and that'd be really useful." Let's say I'm saving $500 a month in cash flow because of my new lower interest rate. Well, what if I kept, so a couple things. People, we try to teach them, okay, so you save 500 bucks, so only three things you can do with money, right? You can prepay your debt, right? Add it to the existing mortgage. You can invest it, or you can blow it, right? You can buy shoes
Mm-hmm.
and sushi and whatever you're going to do, right? But some people also think, and they'll go, well, how much money could I get if I keep my payment the same, right? So that's another way of looking at it. So what if I could get $80,000 and not change my payment? That's a lot of money. I could redo a
Yeah.
kitchen. I could go buy a new car. I could, invest in other real estate. There's other things like that. And I'm not saying you should do that or not do that. It's just, that's a different analysis, right? So when
Yeah.
people pull cash out, if you're paying off other debt, we're going to help you calculate the blended rate, right? Dave, you can talk about blended rate in a moment, like what that
Yep.
means, and does it make sense to refinance and include the debt to pay it all off, or sometimes people think about taking cash out to do something else because now they're saving money. They're like, oh, here's an opportunity to convert some of that house wealth into something else. Right.
Mm-hmm.
So you want to expand on blended rate and that stuff a little bit, maybe if you want.
Yeah, sure. We can spend on blended rate. Let's just keep it really simple with two things. So you got a mortgage at 5%, a bunch of credit cards at 25%. You're not paying just 5% and you're not paying 25%. There's a blended rate of interest in between the two that you're actually paying, which is your blended rate. Um, Sometimes, people are like, oh, I got 5% on this loan and then 6% on this loan. So my interest cost is 11%. Well, no, it's not correct. Somewhere in between the two costs of interest, depending on the loan amounts and things like that. So that's your blended rate of interest. And if you can find a way to save money altogether on across all your interests, that's what you want to do. And then, yeah, we talked about a little bit the cash out stuff. Like you said, if the cash out is being used for something that is beneficial, then it could be good. But it's, when you're just using it to go spend it, that may not be the best use of equity or cash out of your home.
Yeah, fair enough. So, all right, so we've talked a lot about refinancing. At the end of the day, what's a takeaway? What would be a takeaway for you, David, hearing sort of all this? You if someone your age, your generation, hearing about this, what's kind of a quick
Mhm.
takeaway?
Ooh, I think that's a good one. I think a quick takeaway would be that one, refinancing is always available, right, to save on interest, and two, many people they buy homes, they appreciate very rapidly, and it becomes a big part of their wealth. And by having the proper people on your team, proper mortgage person, the proper advisors, things like that, you can really use that wealth to grow wealth and have smart financial moves. So your house could be a great financial tool, and I think the kind of takeaway that I always have from these conversations is that it's smart to usually buy a home and do it smartly.
Yeah, perfect. Thank you. And I don't know, it's that much different from my perspective. The motivations might be different, the financial goals might be different. But at the
Hmm.
end of the day, for the 99%, if we want to call that, how you're going to build your wealth is through your house and your real estate. And just as important is, of course, managing your debt and managing liabilities, managing the debt, mortgage debt, car debt, credit card, all that kind of stuff. At the end of the day, it requires analysis, right? And deep
Hmm.
analysis to make sure you're doing it correctly. I'm glad you point out refinancing is what is available. There are people that refinance and go from a lower rate to higher rate for different reasons, right? I'm not, if you happen to have a 2.87 rate and you say, I'm never ever going to refinance, but then you incur other debts or have other goals, you don't know. You've got to analyze it. And so,
Yeah,
we would always
of course.
say, do the work, right, to figure it out and do a good financial analysis so you know, making a great decision. So cool. All right, David,
Perfect.
anything else?
That's it.
Awesome. Well, thank you. This is our kind of somewhat of a deep dive into refinancing, and we appreciate you tuning in. Take care.